All right, so futures right now, as we mentioned, pointing to a lower start this morning after stocks had continued this upward climb on Tuesday. The Dow achieving another record high, both the S&P 500 and the NASDAQ reaching fresh two-year highs. Meanwhile, the NASDAQ 100 is set for its best year since the tech bubble. Gives you some interesting context there. Here at home, the TSX is poised to enter the year, to end the year higher. And when it comes to sector performance, our tech sector has risen more than 35% since the October lows. All that said, it's also worth noting that we have seen some pretty good momentum for the banks in recent weeks, and the financials are now the second best performing group this year. When it comes to overall performance, though, in Toronto, the other muscular sectors would include the materials and the TSX Energy Group, and they have lagged recently, and they've been some of the weaker performers for the year overall. So, where does this leave us heading into 2024? Let's ask Lesley Marks. She's Chief Investment Officer at Mackenzie Investments. Lesley, great to see you.
Great to see you, John.
What did you make of this year-end rally, broadly speaking, in the stock market?
Well, it has certainly, I would say, surpassed our expectations, the strength in the rally that we've seen really across everything. Interestingly enough, though, when we look at how bonds have performed, I mean, that has been an incredible move since the peak in interest rates that we saw towards the end of October. It's been amazing to see the recovery in bonds as yields have fallen since we've seen a pretty coordinated approach across central banks around the world to talk about the next stage in the monetary policy cycle.
And just to reiterate for our audience that bond connection, if people think interest rates are still going up, there's a tendency to maybe sell bonds because you think, well, hold on a second, you want the yields to perhaps match where rate policy is going to be. So they sell bonds, and that then puts upward pressure on yields, and then people start worrying in the stock market around borrowing costs and all this other stuff. But ever since we started hearing more of a dialogue around lower interest rates, investors started buying bonds again, and that pushed down the yields.
That's right. People really needed to reposition because they weren't positioned for that Fed pivot, if you will. So, I mean, that's what we're really seeing here is a real change in positioning. That's obviously filtered through into the equity markets as well, particularly interest-sensitive securities.
Well, I wanted to get into that because there still seems to be a love affair with tech, as we just highlighted. There's been quite a momentum story playing out with some of those big favorites of 2023. But you have also started to see investors gravitate towards a group like financials. We get a lot of audience questions around those particular stocks as well. What do you think what are the dynamics of the sectors that maybe are outperforming right now versus those that maybe are lagging a little bit?
So I think that the last year was really a tale of two stories. The first, call it 9 months of the year, 9 to 10 months of the year, was really about multiple expansion. Because even though interest rates were still moving higher, what we saw was multiple expansion in areas where growth was predictable. You know, I'm sure a lot of your guests have talked about the Magnificent Seven and the ability to grow no matter what the environment was. So multiple expansion. Then we had, towards the latter couple months of the year, a move that was a little bit more fundamentally driven. When you see that interest rates are coming down, those stocks continue to move higher because that's better for multiples. You would pay more for stocks in a lower interest rate environment. But what changed was the role that those stocks played in the market rally started to diminish a little bit as we broadened out. So what we saw was generally a broadening out beyond those few stocks to mid caps, small caps across the market. We saw a broadening out in sector performance. You talked about financials and how financials have performed more recently, again, driven by that interest rate move. Even utilities, which have been hit very hard by high interest rates and inflationary costs, also starting to participate in the market rally. So it's really hard to group the last year into one trend because it was really two trends that drove the market.
And then if we're trying to get a sense on directionally which sectors could have momentum in 2024, assuming you think there is some more momentum for the stock market, you know, we always talk about these weightings in Canada versus the U.S. because, you know, if you're buying ETFs or if you're buying anything that's sort of tracking the broader market, it does change the look of performance. You know, you add up the financials, the energy and materials. I don't want to discount industrial stocks because they're actually a little bit more weighty than materials these days than the TSX. But if you take those three sectors I first mentioned, they make up about 60% of the Canadian stock market. So if you're seeing lagging performance, I know gold has been catching a bit, but if you're seeing lagging performance on the year from materials and energy compared to, let's say, techs, what does that mean in 2024? What's the kind of trend you see playing out in 2024?
So by any measure, the TSX has been an underperformer this year, not just against the U.S., but against European markets as well. Mostly because of what you talked about the makeup of our market and not having those heavy weights in the favored sectors like technology and communication services. What we see now in this broadening out of the market rally, even in the materials sector, you look at the U.S. residential starts yesterday, huge upside surprise. Guess what sector was rallying the most in Canada?
Yeah,
lumber.
Those lumber stocks were really hot.
So here we have opportunity here under a lower interest rate environment. We will see a broadening out of the market rally, and that should generally be good for the TSX, which is much more cyclically focused, and our economy is also more interest sensitive. So there are some things that were pretty significant headwinds in 2023 that could become tailwinds for 2024 for the TSX.
And just to come back to actual levels of interest rates, because there's this concept, it seems like of everything we've heard, and we've heard a lot in Canada and the US, it feels like at some point next year, there's a good likelihood that interest rates will come down. I think the question is, to what level will they come down? And how does the market react to that? Especially if the market, some people say, well, hold on a second, the market is pricing in too many rate cuts. But if the economies navigate relatively well and inflation trends improve, and there's a commitment to lower interest rates, we just don't know the actual level of rate cuts. What kind of dynamic does that create for the stock market?
So we need to clarify when we talk about lower interest rates. What we've seen already priced into the market across the yield curve is lower interest rates. Where we've seen some stickiness is obviously on the shorter end of the curve because that's more driven by policy. If we just talk about the Federal Reserve, because they've been a little bit more forthright with the expectations for next year. They talked about in their latest meeting that their expectation is for 3 rate cuts or 75 basis points in cuts for next year. The market has already priced in more than 100 basis points in cuts, both here in Canada and the U.S. So to your question, the real question is, have we overshot in that expectation based on the guidance that we've given so far? I think the answer is probably not, because when you look at inflation trends and you look at real interest rates, so that's the current interest rate minus the current inflation rate, if inflation keeps falling, we're seeing pretty significant real interest rates here when we think about inflation in that 2 to 3% level and the policy rate in the 5 to 5.5% level. So we do need to see rates come down. I think that central bankers are just being more cautious because they don't want financial conditions to ease too much, which would then cause inflation to come back. And that's certainly not what they want. They don't want to stop and start and then go back to increasing interest rates, particularly in the context of providing language around the expectation for cuts next year.
Right. And I guess on the inflation front, even in Canada, we saw it yesterday, if mortgage-related interest costs are creating an inflation pickup, is that something that you're concerned about, or actually you're looking through, to your point about the actual level of interest rates in it now versus where inflation goes?
You know what the most important thing is? That the Bank of Canada is looking through that.
Right.
Because they're the ones setting the policy. Of course, we would look through that, but the policymakers have to look through that too, and they are. They have a very good understanding of the role of higher mortgage rates in the inflation numbers.